me about the shift in the last 20 years towards really passive forms of investing versus active investing. And then what role has the 401k played?
So two ways of thinking about it. Number one, there's nothing wrong with passive investment vehicles. I tell my children for their 401ks do that. Don't sit there trying to pick stocks. It's not something you can do as a part-time job, right?
True.
You know, I use a different reference point, which is if the tile falls off my roof, I could go up on that roof and take a hammer and nail knock in the tile. But if I fall off the roof because I'm not really adept at doing this, I could break my neck, right? So the risk reward doesn't make sense. Pay the guy $100, to do it for you. And similarly, I think people work really, really hard for their money during the day, and they shouldn't be sitting there at 8, 9 o'clock in the evening and say, okay, I'll do some web searches and I'll risk my hard-earned money.
Right.
So for them, I think generally speaking, passive products like ETFs make a fair amount of sense. I use them when I go international because I can't do the work on, what's happening in Thailand.
Right.
Or Argentina or something. I don't speak the languages. I don't understand the local cultures. The accounting systems make a difference. So I think it's a perfectly reasonable product to use. It's an efficient product in terms of the cost.
Right.
Okay, relative to mutual funds and things like that. But on the other hand, active management has its benefits too if you have good money managers. So
there's still a role for active management.
There's definitely a role for active management. The best, I'm going to share 2 fun statistics to prove that point. And it may shock people. And I do it almost to shock them. In the fourth quarter last year, 37% of the S&P 500 beat the market by more than 10 percentage points. Okay, so if the market was up 10%, 37% of the constituents, so you're almost talking close to 200 names, 186 or 187 names,
right,
beat the market, and they were up at least 20%.
Wow, okay.
If you look at the first quarter performance, 32% of the S&P 500 constituents, so again, another 160 names, beat the market by more than 10 percentage points. And there's this obsession almost with 5 or 10 names that this is all that's all the market.
Right.
No, there's a lot of good stock picking you could have done even if you forgot about those 5, 10 names. So there's always been a role for stock picking. The problem is you have to avoid the losers too, and that's harder. And even if you may have a loser that you couldn't help, right? You bought a stock because you thought the new management that came in was fabulous and they're really, really great and they're going to turn this business around. They've done it before, and you have a lot of faith in this management team. And God forbid, the plane that's carrying the CEO crashes into a mountain.
Yep. And
your whole story just got destroyed. So did this person's family. But I'm saying the notion of you could have done all your research and still had some horrible luck in terms of your stock picking. So I don't sit there glibly saying you have to avoid the losers because sometimes it's out of your control.
Right.
But the notion that stock picking can make a ton of money is still very, very much the case. It's never gone away. It's been one of the best, if you go back decades, it's been one of the best ways to make money is stock picking. So I've always felt there's a role for that, even as we've moved towards more passive vehicles. And for 401ks, again, it's easier for people not to have to sit there and start trying to pick stocks and being that brilliant, because most of us aren't. I'm married 36 years. My wife tells me that pretty regularly. I'm not that bright. She's generally right, but just don't tell my clients.
So, but by the same token, you in one of the recent pieces that you wrote, you said that we really couldn't hide behind the 401k movement as we might have been able to in 1982.
So what we're really talking about is household equity exposure. So if you look at the Federal Reserve Board data, stuff you're familiar with from your days at the Fed.
Flow funds.
So there's a segment in there looking at the household sector, which is your retail investor, individual investor, but it tends to skew to wealthier people because they're the ones who own the assets.
Right.
That their exposure to equities as a percent of their financial assets are near 50-year highs, if not at 50-year highs right this minute. Stocks have not, we always get data with a lag, which means they're pretty fully invested. So over the past year or so, from the bottoms in March of last year, the equity market globally has added $50 trillion of assets. It's a staggering amount. $1 trillion would be staggering. 50 trillion. This is, you just, mind can't comprehend that. But that's bumped up their equity weighting as those stocks appreciated. And they're not devoid of investment participation, right? They are fully invested. In 1982, 83, I think 84 was the low. Equity investing as a percent of or equity holdings as a percent of financial assets were really, really low.
Yeah.
So that was an incredibly starting point. As you buy stocks, you bid them up by price, right? Too much demand, not enough supply, price goes up. And that's what they did. And now, if you look at the future based on that, the returns over the next 10 years are unlikely to be that good based on when you've had these kind of levels of investment proportions. So there's arguments that people have to use the 401ks today as a way of building their retirement because you don't have the defined pension program anymore.
Right.
Right. But I could have made the same argument in 1990, and I could have made the same argument in 2000, and we still had some tough years. So I think that argument, people had to do that already 2 decades ago.
But,
by the way, it's hard to even think about that for a second. That the tech bubble was more than 20 years ago. So you have a whole new generation of investors, of young people who have no idea it ever happened, right? Because if it didn't happen, if it's not in your memory, it kind of didn't happen.